Right now, somebody younger than you, with less talent than you, and maybe even less money than you, is quietly building wealth while you scroll. And 10 years from now, that difference becomes massive. Because investing is one of the few games in life where small decisions compound into life-changing results. Tiny habits, tiny investments, tiny choices repeated consistently over time. That's how financial futures are built. But here's the problem. Most beginners don't lose money because they're stupid. They lose money because they make a few simple mistakes that quietly destroy wealth for years before they even notice. And the dangerous part? Some of these mistakes actually feel smart in the moment. They feel safe, logical, responsible, but over time, they slowly trap people financially. Today, we're breaking down the 7 investing mistakes beginners must avoid if they want financial freedom instead of financial regret. And stay until the end, because mistake number 7 is the one silently keeping millions of people trapped in the middle class forever. Also, if your investing strategy comes entirely from TikTok comments, we need to have a serious conversation. Most people think investing is about finding the perfect stock, the next Apple, the next Tesla, the next crypto that goes to the moon. But wealth is rarely built through perfection. It's usually built by avoiding catastrophic mistakes consistently, and the first mistake destroys more beginners than market crashes ever will. Mistake number 1, waiting for the perfect time. Beginners constantly say things like, I'll start when the market calms down. I'll invest when I make more money. I'll wait until inflation improves. I'll start next year. But here's the truth. The perfect time never arrives. There will always be uncertainty, always bad headlines, always political drama, always market fear, always another reason to delay. And while people wait, time keeps moving. That's the part most people underestimate. The market doesn't reward perfection, it rewards participation. Someone who invested consistently during uncertain times usually beats the person who waited for certainty. Because time in the market matters more than timing the market. Think about it. People spend years waiting for the perfect entry while missing massive long-term growth. That's like refusing to board a plane because of turbulence, while forgetting the plane is still heading toward the destination. And honestly, many people are not actually waiting for the perfect time. They're waiting to feel emotionally comfortable. But investing almost never feels comfortable in the beginning. There's uncertainty, fear, self-doubt. That's normal. But delaying investing doesn't eliminate risk. It creates a different kind of risk. The risk of reaching your future without financial progress. Meanwhile, money sitting in savings accounts slowly loses purchasing power to inflation. Everything becomes more expensive over time. Food, housing, transportation, life. So doing nothing with money is still a financial decision. And one of the biggest regrets older investors have is not starting earlier. Because once people finally understand compounding, they realize time was the most valuable asset they had all along. And that leads directly into mistake number 2, chasing hype and fast money. This is where beginners get emotionally trapped. A stock suddenly explodes. Crypto goes viral overnight. Social media says, this could 100 times. Last chance before it takes off. Millionaires are made here. And suddenly, everyone becomes a financial genius for 3 weeks, until reality shows up. Here's the dangerous part. People confuse gambling with investing. Real investing is usually boring. It's consistency, patience, discipline, long-term thinking. But beginners chase excitement. Because excitement feels productive. Watching charts constantly, refreshing portfolios every 10 minutes, jumping between trends. It creates the illusion of progress. But emotional investing destroys wealth faster than bad investments ever could. Fear of missing out, panic buying, panic selling, overconfidence during hype, despair during crashes. That emotional roller coaster wipes people out psychologically. The wealthiest investors often look calm during chaos, because they understand something beginners don't. The market transfers money from the impatient to the patient. And social media makes this dramatically worse because nobody posts boring consistency. Nobody goes viral saying, I calmly invested into index funds for 15 years. Instead, people post screenshots of insane gains, luxury cars, private jets, retired at 25 stories. But what you rarely see are the thousands of people who lost money chasing shortcuts. You only see the survivors, not the graveyard behind them. That creates distorted expectations. People start believing wealth should happen quickly, and when it doesn't, they abandon investing completely. Imagine planting a tree, then digging it up every week because it hasn't grown fast enough yet. That's how most people invest, constantly interrupting growth because they're addicted to excitement. And if your portfolio gives you a heart attack every morning, that's not investing. That's emotional damage with graphs. But emotional investing becomes even more dangerous when beginners make mistake number 3, investing in things they don't understand. A shocking number of people buy investments they cannot explain at all. They buy because someone online sounded confident. Trust me, bro. This stock is guaranteed. This company can't fail. That is not research. That is financial roulette. If you cannot explain in simple terms how a company makes money, why it could grow, and what risks exist, you probably shouldn't own it. Because when markets crash, confused investors panic first. Knowledge creates confidence, and confidence creates discipline. The best investors don't buy random opportunities. They buy businesses they actually understand. And here's the irony. Most people spend more time researching a new phone than researching investments that could shape their future for decades. They'll watch 20 reviews before buying headphones, but invest thousands of dollars because a stranger online yelled confidently beside a rented Lamborghini. That's insanity, and unfortunately, many beginners mistake information for understanding. Repeating financial buzzwords is not understanding. Memorizing stock symbols is not understanding. Copying influencers is not understanding. Real understanding means you could explain the investment clearly to another person. Simple, logical, rational. Because investing should never feel like blind faith. And honestly, a lot of financial influencers make money from attention, not investing. Remember that. A flashy lifestyle does not equal financial wisdom, and that leads directly into mistake number 4, trying to get rich too quickly. Social media has completely distorted people's expectations about wealth. Every day people see stories like, teenager becomes millionaire overnight. Crypto trader retires at 27. This investor turned $500 into millions. And after seeing enough stories like that, normal wealth building starts feeling too slow. But here's the truth nobody wants to hear. Most real wealth is built slowly, quietly, without applause, through repetition, small investments, over years, compounding consistently in the background. That's not flashy, but it works. The people who become financially free usually master boring habits long before they experience exciting results. Because investing is not about looking rich, it's about becoming financially unbreakable. And unfortunately, many people would rather look wealthy temporarily than build actual long-term wealth. That's why people finance luxury cars they can barely afford, buy designer clothes on credit, upgrade lifestyles immediately after getting raises. They chase appearances instead of ownership. But wealth built recklessly often disappears just as fast as it arrived. Meanwhile, wealth built patiently tends to last, and this is what most beginners completely underestimate. Compounding rewards consistency, not intensity. You do not need one perfect investment. You need many years of disciplined behavior. That's what creates real financial security. And speaking of dangerous habits, mistake number 5 silently drains wealth every single month. Lifestyle inflation. This mistake traps people even when their income increases. They make more money, so they immediately spend more money. New apartment, new car, luxury vacations, expensive subscriptions, constant upgrades, and suddenly, higher income changes absolutely nothing because every extra dollar earned immediately disappears. This is one of the biggest financial traps in modern culture. People assume wealth comes from earning more, but wealth is often determined by the gap between what you earn and what you keep. A person making $70,000 who invests consistently can eventually outperform someone making $200,000 who spends recklessly. Because money magnifies habits. If someone lacks financial discipline, higher income simply creates more expensive mistakes, and social media constantly pressures people to upgrade their lifestyles. Everyone feels behind, everyone feels like they should have more, but many people looking rich online are financially fragile in real life. Luxury financed, debt hidden, stress ignored. Real wealth is often quiet. It's investments, ownership, assets, cash flow, freedom, not constant flexing. Some wealthy people drive normal cars, wear simple clothes, live below their means. Because their goal is not external validation, their goal is freedom, and freedom requires margin between what you earn and what you spend. But the person constantly upgrading their lifestyle often becomes trapped maintaining appearances, and honestly, some people are financing lifestyles to impress people who literally do not care. Now here's where investing becomes psychological, because mistake number 6 destroys people during hard times: panic selling during market crashes. Market crashes expose emotional weakness. When prices fall, beginners panic. They sell, they freeze, they assume the world is ending. News headlines become terrifying. Social media becomes hysterical. Fear spreads everywhere, and emotionally, selling feels safer. But experienced investors often react differently. They stay calm. Why? Because they understand market downturns are normal. Every major crash in history felt terrifying in the moment. Every single one. People always believe, this time is different. The system is collapsing. The recovery won't happen. But historically, markets recover over time, not instantly, not perfectly, but consistently over long periods. The people who panic sell often lock in losses permanently. Meanwhile, impatient investors continue buying quality assets at lower prices, and that's where fortunes are quietly built. During fear, not comfort. This is one of the hardest psychological lessons in investing. The moments that feel safest emotionally are often the worst financial decisions, and the moments that feel uncomfortable are often the greatest opportunities. That's why emotional control matters so much, because the biggest enemy in investing usually isn't the market, it's your emotions. Fear destroys discipline, greed destroys patience, panic destroys compounding, and unfortunately, most people don't realize this until after they've already made expensive mistakes. That's why successful investing is less about intelligence and more about behavior. Can you stay disciplined when headlines become scary? Can you continue investing during uncertainty? Can you avoid emotional decisions when everyone else panics? That's where wealth gets built. And that leads to the final mistake, the most expensive mistake of all: never starting. This one quietly destroys decades of potential wealth, not because you missed one opportunity, but because every year delayed reduces the power of compounding. Most people dramatically underestimate what small, consistent investing becomes over decades. They think, it's only a little money. It won't matter. I'll start later. But later turns into years, and years become regret, because compounding needs time. The earlier you begin, the harder time works for you, and future you will either thank you or regret today's decisions. One day you'll look back and realize the years passed anyway. The question is, did your money grow with them? That's the painful truth about investing. You cannot recover lost time. Money can be rebuilt. Mistakes can be corrected, but years disappear permanently. And unfortunately, many people spend their 20s and 30s believing they have endless time, until suddenly, they don't. Then panic begins. People start trying to catch up, taking reckless risks, chasing shortcuts, making emotional decisions from desperation. But most financial stress begins much earlier with procrastination. And honestly, the difference between financially free people and financially stressed people is often smaller than it appears. Small habits, repeated consistently, for long periods. That's it. Financial freedom rarely happens overnight, it happens quietly. One investment, one smart decision, one disciplined habit at a time, and eventually, the life that once felt impossible becomes normal. That's how wealth usually happens, not dramatically, but gradually. Until one day, you suddenly realize your money is working harder than you are. You have options, you have stability, you have flexibility, you have peace. And that's what investing is really about. Not showing off, not chasing hype, not impressing strangers online. Freedom. The freedom to make decisions without constant financial stress. The freedom to handle emergencies calmly. The freedom to choose how you spend your time. And perhaps most importantly, the freedom to stop living paycheck to paycheck emotionally. Because wealth changes more than your bank account. It changes your stress levels, your opportunities, your future choices. And the people who understand this early and gain one of the biggest advantages in life. So if this video changed how you think about money, subscribe to Wealth Roots 101 for more videos on investing, wealth building, and financial freedom. Because the decisions you make today could completely change your next 10 years. And remember, the best time to start investing was years ago. The second best time is now.